investors essentially look for bargains when they're buying stocks and shares or any investment. Now, what they're doing is going early and buying something that probably is unloved. It might be because a company is having trouble, or it may be that they feel there is a company offering good opportunities because they are developing products or whatever into the future. And so therefore, by buying the share price early when it's low and not popular, when that revalues and the rest of the market suddenly realises what a great opportunity that this company or share offers, they will go and buy it and the price will rally. Now, a value investor will therefore make a lot more money as the share price rallies. Now, value investing is very subjective because you need to determine what makes good value. So how do you do that? They look at companies' accounts and all sorts of factors and values that can be incredibly complex but very subjective at the same time. So a value investor there's a graveyard of investors out there who have bought things because they thought they offered great value and they were cheap, but they never ever revalued and they've actually lost a lot of money. So value investing is one way of investing, but there are others. A momentum investor will try and ride a wave that's more than likely already established. So think of it like a surfer who's paddling in the water and he sees a big wave coming already, and then he paddles and gets on that and then rides it to the beach. Now, that makes it incredibly powerful if you get it right, but of course if you get it wrong you can actually ride momentum downwards. Now, there are different measures of momentum that people have and different time scales in which they're looking at momentum when you're talking about investing, but it's incredibly powerful because it actually incorporates some of the other styles. Earlier we mentioned value investing. Value investors might get in early, but momentum investors will probably only get in once a trend has established, and then will jump on it. They won't get all of the upside, but they'll get a lot of it as it becomes more powerful. If you're into momentum investing and you want to know more about it, then check out my 80/20 DIY investment service, which is very much momentum driven. Now, this debate infuriates me because there's a lot of misleading stuff printed by both sides of the debate. Now, a passive fund is something that's typically run by a computer that just tracks an index, say the FTSE 100 up and down. So you basically get the market or the index that particular fund tracks. Now, an active fund is run by a fund manager or a team of people where they invest based on their own convictions. Now, which does better over the long term is usually, well, the evidence has suggested it's a passive investment strategy, but that is actually flawed research because nearly every research I've seen suggests that people buy and hold one or either or any fund for the long term. But if you are buying something to hold for 20 years, regardless of what it is, you're making a mistake because every dog has its day. Every investment strategy will have periods where it will outperform and where it will underperform. So the tip is there's evidence and research that I've done that shows that if you invest in passive or you invest in active strategies at the right times, that's how you perform. It's about regularly reviewing your portfolio and making changes and being in the right investment at the right time. And that's why momentum investing can win out and does win out over value investing in the long term. Send your questions in to Damien at moneytothemasses.com, and you can do Twitter at money2 with the number 2, the masses, and you can obviously hit me on Facebook.